the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, sectors, and of course the companies to watch. But as always, here's a quick recap of some key movements. While Singapore shares lower, as all eyes remained on escalating trade tensions in the region. Now that's of course after Beijing's retaliatory tariffs on certain US farm goods took effect today. Now if we look at the Straits Times Index, it was down 0.17% at 3,908 points as at about 12:20 p.m. Singapore time. Value turnover, we're looking at 526.29 million Sing dollars back then in the broader market. Now let's take you through the closing numbers. The STI ended in the red as well, down 0.39% at 3,899 points. In terms of value turnover, we're looking at 1.26 billion Sing dollars. Now, gainers trailed losers 195 versus 320. Top advances for today we've got for UPC partner, GMH-USD and New Incorporation USD. And top decliners we've got for USGX, Helens and DBS. Well, in terms of companies to watch, we have Hongkong Land because the property developer had on Friday posted an underlying profit of $410 million for the financial year ended December, down 44% from the level we saw a year ago. Now, elsewhere, from how Asian markets reacted to China's retaliatory tariffs on U.S. farm goods to oil prices declining on the back of concerns over U.S. import tariffs, we've got more international headlines in focus. And joining me on a Monday is David Kuo, co-founder of The Smart Investor. Mr. Kuo, how are you?
I'm very good, Tian Tian. How are you?
Good. And let's start with the U.S. stock market this time around. Data out on Friday Friday night, I believe, showed U.S. non-farm payrolls increased by 151,000 jobs in February. The number's lower than the 160,000 jobs increase expected by economists, seen as somewhat lukewarm. How far can we rely on the numbers given the latest Dodge federal layoffs, the impact of U.S. tariffs? How did Wall Street react to the new set of numbers?
Okay, Wall Street reacted quite well to the numbers. And I think what we can say, Tian Tian, is that jobs were created, 151,000 jobs, sure. I mean, they fell short of analyst expectations, but nevertheless, 151,000 jobs. So that probably means that the Federal Reserve doesn't really need to do anything dramatic at the moment, and they can probably afford to sit on their hands for a bit because the economy looks to be okay. But your question about the Doge job cuts, those haven't actually figured in the numbers just yet, so we might see them reflected in later numbers that will be coming out, and then we'll just see how bad they really are. And I think the other thing is that we're hearing that some companies in America are starting to retrench workers. So they are making workers redundant. So this may be the best numbers that we're going to get for a while. And I think future numbers could indicate that the American economy is starting to slow and that there will be fewer jobs created and more jobs being lost by many companies over in the U.S.
And since we're on that topic, if I may just pop over an impromptu question, right? Trump didn't roll out the possibility of a recession. He says it is a period of transition for the U.S. economy. How would you read into that?
I can see a recession coming. And I'm just writing a piece at the moment about all that is going on in America, and it looks to me as though, there's going to be a dramatic slowdown in America. That is inevitable, and what I think Trump wants to get at is that he wants to reduce the national debt, and he's got to do something pretty dramatic. And I think he's going through this scorched earth policy at the moment, where he's scorching everything that he possibly can. Immigration, tariffs, federal workers, federal government workers. He's scorching everything in order to try and bring down the budget and at the same time try and bring down the national debt. The result of that, the upshot of that, again, has to be an economic slowdown. Whether that slowdown will result in a recession that some people are suggesting, or it will just be a recession, a massive slowdown, is something that we will have to wait and see. But I think we're going to see slowing economic growth to the point where the American economy could start to splutter. The danger, Tian Tian, is that there is still inflation in the system. So when you have a slowing economy and you have inflation at the same time, you end up with that horrible S word, stagflation, which means that the economy is going to be stagnant and at the same time you're going to get inflation. And then I don't know what the Federal Reserve is going to do under those situations. Are they going to focus on the inflation aspect or are they going to focus on the slowing economy?
Since you mentioned about slowing debt, if I may just again pop a follow-up question.
You have a lot of those, Tian Tian.
You mentioned a lot of good points, Mr. Kuo, and one of them is about lowering the debt. So what benefits will lowering that debt mean for U.S. equities, for instance, and what good will it do for Trump, actually?
Well, at the moment, I mean, the U.S. debt is about 120% of national GDP. So we're talking about $36 trillion of debt.
Yeah.
Well, put yourself in the position of a household, right? You've got a massive credit card debt. And I remember Janet Yellen this time last year saying that, don't focus so much on the debt. Focus on the interest payments instead. In other words, the interest payments are serviceable. And so she was saying it's only $1 trillion a year that's going out to service that debt. So it's manageable. So let's not worry about that. But it's almost like somebody with credit card debt. I can pay the interest payments. I can't pay the principal, but I can certainly service the interest that is being levied on my credit card debt. Well, I mean, that is a recipe for disaster, Tian. And I think it's the same with America. So I think what will happen is that, the American economy will probably slow. And I think America may go into recession. But as far as investors are concerned, that is when you need to look around for industries that are able to cope with recession. And there are many companies out there that have that ability to deal with a slowing economy. And you have to invest in companies that make the things that people can't do without. And if you do that, then I don't think you will be going too far wrong, Tian Tian.
I suppose we're looking at short-term versus long-term benefits then. Going back to the Singapore stock market as usual, Mr. Kuo, how did the STI fare today? Any surprises when it comes down to the biggest movers, say Hongkong Land, after it posted its latest earnings?
Okay, the Singapore market, I think, was just sitting on its hands today. It was down a few points, 0.3% or something. And I think, the general feeling I have is that people don't really know what to invest in right now, so they're not investing in anything. Yeah. And so they're not actively selling and they're not actively buying at the same time. But you raise an interesting point about Hongkong Land. I do own shares in Hongkong Land, and I've been watching this company for many, many years now. And I think Hongkong Land has accepted the fact that build to own properties is very risky. You invest in a piece of land, you build the property, and it could take you, 3, 4, maybe 5 years to get that property up. And during that time, you have no idea what the market is going to be like. And I think in the case of Hongkong Land, it's going through this transition right now, and it is saying that they don't want to play this game anymore. They don't want to build houses and wait 5 years to see whether or not they can sell them. And so instead, they're just going to focus on the major cities, the gateway cities, and it's going through a transition in much the same way that America is going through a transition. It will be very, very painful. And but interestingly enough, they increased their final dividend by about 6%. So what they say is that they have confidence in what they're going to be doing, and I think they're going to be looking at recurring revenue rather than build something, sell it for a profit, and then make a big one-time gain.
Okay. Now let's also zoom in on some of the other companies to watch for today. Mr. Kuo, we've got here Keppel, because Keppel announced that its private investment vehicle, Keppel Infrastructure Fund, and its co-investor have acquired 100% stake in the UK-headquartered Global Marine Group. How significant is the purchase for Keppel given the counter's share price movements today?
Well, the counter moved about 0.4 of a
not very
cent,
much.
so it was down about 3 cents today.
Yeah.
So the market is neither one way or another about this purchase. But I think the company itself said that it is not going to impact earnings and it's not going to impact its asset value either. So on both those scores, not much to see there. But I think it is an interesting acquisition because this company lays undersea cables, and I think this is a long-term project as far as Keppel is concerned. And I think investors should be reassured by the fact that this company has found assets out there, companies out there that are worth buying that will hopefully generate that recurring revenue that we were talking about with regards to Hongkong Land. Recurring revenue is everything, Tian.
And staying in Singapore, Mr. Kuo, we've got news that financial services firm Chocolate Finance has temporarily suspended instant withdrawals due to high demand. Now, how concerned should investors be regarding this, or is this part of the gains to be expected from a startup?
Well, this is a tough one, Tian.
Yeah.
Because I remember a few months ago, I was having a look for a home to park some money, and I came across Chocolate Finance, and I saw the interest rate that it was offering, and it was higher than anything that I could get in the bank. And I thought, is it worthwhile? Then I had a look, and I realized that it isn't really a bank. The company takes your money, and it goes and invests it, and then with the returns that it gets from its investment, it can therefore afford to pay you a higher rate of return. So it's not as though it is a bank, and it is not regulated as a bank, but instead it's an investment product. If you are comfortable with that, then by all means. But I think what has been highlighted today is that when everybody wants their money back, the money isn't there. They have to sell their investments in order to generate the cash that is required to pay people. And so whilst on their website they say that, instant withdrawals are okay. Yeah, instant withdrawals with a time delay. If you're prepared to wait whatever it is, the 4 or the 10 days before you get your money, then by all means. But otherwise, it's not really instant withdrawal. It's not a bank, and there are risks involved. Is it a problem with a startup? I think if all of us today went to the bank and we said we wanted our money back, regardless of whichever bank we bank with, right? If we all went in and said we want our money back, the bank could not possibly pay us all our money back because the money is used for other things. And so there will be a time delay before you get your money back. This is really no different. The only difference there is that the money that has gone into the company, Chocolate Finance, has been invested, and they've got to liquidate that investment before they can actually give you the money. So there's a slight difference there, and they haven't got access to the cash immediately, but I think they're going to be. I think people are going to think twice about these kind of companies in the future.
Okay, now if you're just tuning in, we're now in conversation with David Kuo, co-founder of The Smart Investor. Well, Mr. Kuo, across the region, all eyes on China because Chinese tariffs as high as 15% on a range of U.S. agricultural goods took effect today, potentially exacerbating a trade dispute between the U.S. and China. But of course, observers say Beijing's move appeared to be calibrated to prevent that kind of escalation. But how did Chinese and Hong Kong markets fare in reaction, and also taking into the account the latest consumer prices figures out of China because it fell for the first time in over a year?
Yeah, I think there are two completely different issues here. The first one is, what did we expect? Did we expect China just to simply sort of say, America's going to slap tariffs on us and we're going to do nothing back in return? Yeah. So no matter how calibrated it is going to be, Trump will see it differently, and Trump will just see it as being tit for tat. And so therefore, the next round of tariffs could actually come from America again. So calibration doesn't really sort of help in this in this case. But with regards to the falling CPI, the falling inflation numbers, almost to the point of deflation, that I think is worrying because it means that people in China are not going out and spending. And we heard recently that the government wants to drum up interest in consumers going out there and spend in order to drive the economy. And it looks to me they have a lot of work to do in order to try and get consumers to have enough confidence to go into their bank accounts, take the money out and go and spend. Only when they spend will you be able to drive up inflation. But it's not happening based on these numbers. So the government has to do an awful lot more in order to try and get consumers to go out and spend. If they don't succeed in doing that, China has a problem. China will have a problem. And its economic growth, it says it's going to achieve 5% roughly this year. I don't think it's going to be anywhere near 5%.
Okay, and as we looked at the markets in Hong Kong down 1.85% and mainland China, the Shanghai Composite down 0.15%. That's what we are looking at as well for today. Well, further away, Mr. Kuo, oil prices fell today as concern about the impact of U.S. import tariffs on global economic growth and fuel demand, as well as rising output from OPEC Plus producers weighed on the good. So if we look at Brent crude, that's down 25 cents or 0.4% at about 8 a.m. Singapore time. What do you think are the levels to watch for oil given the ongoing trade uncertainties?
Well, if they hang around at these levels, I think oil producers will be quite happy. But oil prices are a function of supply and demand. And at the moment, it looks as though there's going to be an increase in supply. And so therefore, we would expect oil prices to fall. But at the same time, Tian Tian, we go back down to this issue of slowing economic growth to the point of recession. And if we do have slowing economic growth, there is less demand for oil. And if there's less demand for oil, then we would expect oil prices to continue to fall. So I think everything hinges on the two biggest economies in the world, America on one side, China on the other. What are they going to do? Are they going to drive the whole world into some kind of recession, or are they going to wake up, smell the coffee, and go, right, we need to do something about this? And I can't see it happening in the immediate future, and I hate to be so depressing, but I can't, until these two leaders sit down, and they haven't spoken to each other yet, until they sit down and have a chat and try and sort out their problems, they're going to drag all of us down, because ultimately China and America are inextricably linked, and they're never going to be able to break that bond between the two of them. So let's learn to live with each other, yeah?
And as we look at Brent prices right now, $70 and 58 cents a barrel. Well, before we let you go, Mr. Kuo, earnings once again in focus. Global earnings-wise, I believe today we've got Jardine Matheson Holdings that'll be closely watched. For this week, we've got CrowdStrike, Inditex, Adobe, Rheinmetall, which is a defense company, Foxconn as well. How would you prioritize what to watch?
Well, for me, Tian Tian, in a selfish mode, Jardine Matheson, because I have shares in Jardine Matheson. So we've already heard from a couple of Jardine Matheson companies so far. We've heard from Mandarin Oriental. They were okay. We heard from Hongkong Land. Dividends were up. And so we only have DSI Retail, which owns Cold Storage and Giant, to report yet. And I think Jardine Matheson results are going to be okay. They're a conglomerate, so they have lots of money coming in from all sorts of places. And the thing to watch is whether or not they're going to be able to increase their final dividend. So that's Jardine Matheson. Inditex, I mean, that is one that should interest you, Tian Tian. Yep, they own Zara. I know they own Zara, Massimo Dutti, and Pull & Bear, all of that stuff. I can see you in a Pull & Bear T-shirt. I think we want to know, because this is a global company. And the last set of numbers, the third quarter numbers, I think, weren't that bad. And so I think people will be looking to Inditex to give them a feel as to how the global consumers are faring at the moment. And Inditex, together with another company, Fast Retailing, that owns Uniqlo, I mean, those two companies tell us an awful lot about what's happening in the world. As far as the others are concerned, Adobe, interesting, how they're going to be able to manage AI in their product. Foxconn, with regards to iPhones, how are they doing at the moment? But that other one, that Rhine, the
defense company.
I know, yeah. I mean, they're all the rage at the moment. Everybody is looking at these defense companies, and they will have an awful lot to say about whether or not they're getting lots of contracts coming in from Europe, and is Europe going to be beefing up its defense budget, and how is that going to impact the company over the long term? So plenty to look out for, Tian Tian.
So U.S., a global economy first, those that tell you about the global economy, and thereafter defense spending in Europe. Thanks so much, Mr. Kuo. That was David Kuo, co-founder, The Smart Investor.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.